So another car financing company has filed for bankruptcy. People are starting to not pay their car loans. First was Tricolor going through it, then it was First Brands, which is a completely debt-stuffed auto parts roll-up, and then Primaland, which is a lender to used car dealers, is in Chapter 11 with a syndicate of regional banks on the hook. So this is very much late cycle consumer credit stress starting to show up. When auto financing gets shaky, that means that the rest of the economy could get shaky too. So we got some data about credit card spending. JP Morgan, Amex, Capital One all say card spend is up 7.5% year over year. Delinquencies are easing, banks are even loosening standards again. But that's because all of the spending is coming from the top. It's high FICO, it's premium card holders, the people with like $900 platinum fees and Amex lounges. The Philadelphia Fed found out that once you strip those out, inflation-adjusted spending among lower credit consumers is actually falling. So we really have this barbell economy where lower income consumers are really struggling and higher income consumers are really spending. They're like half of all consumer spending, despite making up far less than half of the overall economy. And everything is also like really bifurcated and really confusing right now. So gold has gone down quite a bit. Gold, a safe haven asset, people are selling out of it because they want to take their returns. There's like technical selling going on because people are like, gold has run up too much. And then things like Beyond Meat are totally skyrocketing. It rallied 1,300% in 4 days because it got meat. Citi says retail trading accounts for 16% of total stock trading, which is the highest on record. Quantum computing stocks, which the administration is actually playing around with a little bit. Crypto ETFs, silver, all back in fashion. And then you have the poor Federal Reserve, who is like, okay, so we have this clear problem with lower income consumers really struggling to make payments. We have these defaults happening in the auto sector, which is going to put pressure on private credit, put pressure on the banks. And then we have this wild stock market that's still driven heavily by AI, but also being memed again, which is not necessarily the financial conditions that you would want to cut rates in. Oil prices are also going up because the US has sanctioned half of Russia's production. US shale growth is topping out too, which means the world's spare capacity is basically 2 countries, Saudi Arabia and the UAE. Great for those countries, but probably not good for the rest of the world, just in terms of oil prices. So that's going to be more upward pressure on inflation too. So there's several different pockets of the economy, but those pockets are becoming deeper and they're becoming more refined. And there's going to be more upward pressure on prices, most likely because of what's going on with energy, because of what's going on with auto. And then there's like perhaps systemic risk with some pockets of private credit, and then like fake meat companies. And then also like they're demolishing the White House.